Alright investors, today let's talk about ASX Limited, the company behind the Australian Securities Exchange itself. The stock has recently corrected about 20% and now we are starting to see some signs of oversold stabilization. ASX was founded in 1987, headquartered in Sydney, and it is Australia's only fully integrated securities exchange platform. Thanks to Australia's massive listed resources sector, ASX holds a near monopoly position across several key business lines. The moat is deep, and with a market cap around 12.2 billion Australian dollars, a net profit margin of 44.36% and ROE of 13.39%, this business is basically a cash machine. For FY 2026, the net profit is expected to reach around 580 million Australian dollars with EPS of $12.67, up about 5%, and the expected dividend is $2.30 per share, giving the dividend yield of around 3.69% with 100% franking. That is attractive for income-focused Australian investors, but let's be clear, the growth is slow. Revenue growth is only around 0.2% and earnings growth is about 1.23%, far below the broader capital market industry growth rate of 10.26%. In plain English, this is more like a bond proxy than a high growth stock. It is built for investors who want stability, not moonshot returns. Technically, momentum is still very weak and trading volume has been shrinking, and this is the kind of slow grinding chart that can really test patience. My conclusion is simple: monopoly mode, high dividend and defensive quality create a solid triple support logic, and ASX can work as a portfolio anchor, especially for investors looking for a steady income. The 3.69% dividend yield gives some downside protection, but don't expect this thing to rip to the moon. This is not a YOLO growth trade. This is a defensive income play, and you can hold it for the dividend, not for the fireworks.